Thank you for joining us for this evening's program with Roger Ferguson in conversation with Richard Bard. I'm Claire Noble, the Director of Programming for the Vail Symposium. On behalf of Chris Sable, our Executive Director, Dale Mosier, our Board Chairman, and the entire Vail Symposium Board, welcome. We're in our 49th year of providing the Vail community with thought-provoking and affordable programming. A few program notes before we get started. To ask questions of tonight's speakers, please use the Q&A option at the bottom of your screen. You can type those in there at any time, and we'll get to those later in the program. Tonight's program will run until 7 p.m. It's being recorded, and you'll be able to find that recording at vailsymposium.org. I'd like to take just a moment to thank the organizations and individuals who've helped make tonight's program possible. Our sponsors include the Town of Vail, Vail Resorts Epic Promise, the Antlers at Vail, and the Vail Daily. Our virtual programs are sponsored by Alpine Bank. Jeannie and Dale Mosier have underwritten the winter season, and tonight's program was underwritten by Brian Stockmar, Susan Camerlin, and Paul Chapman. The Vail Symposium is supported by a generous grant from the Frechette Family Foundation. Thank you to all of our donors. This is the final program of our winter season. And after a brief hiatus, our summer season kicks off on Wednesday, May 19th. Constitutional scholars Keith Whittington of Princeton University and Stephen Vladeck of the University of Texas discuss constitutional interpretation of several pressing issues. Attorney Ron Robbins moderates. Now we turn our attention to the economy. Our distinguished guests are Roger Ferguson Jr. and Richard Bard. Richard is the founder and chief executive officer of Bard Capital, a middle market private equity firm with a diversified portfolio. And he previously served as the chairman of the Federal Reserve Bank of Kansas City. He's our principal interviewer for Vail Symposium's financial series. I'll turn the program over to Richard, and he will introduce tonight's speaker, Roger Ferguson.
Thank you, Claire. What a great honor to have Roger with us. And I'm looking forward to a great program tonight. So a few months ago, we thought this would be a great time and a great idea, as there'll be many sort of meaty topics to consider for what's going on in our economy, change of administration in Washington, the impact in our lives of the pandemic, and so much going on in terms of the stock market and its effect on people's wealth, the price of real estate, all these kinds of things that as we know, impact our country and the attitude and wealth of our people. So we have no disappointment. I mean, there's been a tremendous amount of policy changes. There's been some impact on various industries, including energy, foreign policy, immigration, as we know. But there's also been a couple of major relief bills. That one is the American Rescue Plan, and the other now is proposed to be the American Jobs Plan, which are going to infuse tremendous amount of new capital into our system. So we have lots to talk about. For a little bit of context about Roger and I, there's a history that goes back about. I know Roger's smiling because I have this picture of him with his Coke bottle glass, and it's my blackmail. But he says they're probably at the Smithsonian now, because he's also a member of the Smithsonian board. But basically, Roger and I met back in the early 80s when I was a young entrepreneur taking my first company public. Roger was then an attorney at Davis Polk in New York, and part of a team that worked on my IPO, initial public offering. And then from there, I went on to run several public companies, and obviously at some point form my own partnership and investment company. Roger did a lot of really smart things. He went back to Harvard and got an economics degree, a PhD in economics. He's also an attorney, obviously, but then went on to join McKinsey and then Swiss Re, and then eventually became the chairman of TIAA, CREF at the time. And I'd be curious to ask Roger if we get around to it, if he ever liked that name, but it certainly was notable. But Roger and I re-met almost 20 years later. I became the chair of the Kansas City Federal Reserve Bank, and it was one of those situations where I had no idea really what I was doing, but they sent me off to Washington to meet the chair of the governors that was in charge of bank affairs, oversight of the regional Federal Reserve banks. And I sat across the table from Roger Ferguson Jr. And of course, he took me to task. So I never forgot that. But Roger was notably 9/11. He was the one who was running the reserve, as Chairman Greenspan was in Europe, if I remember right, and could not get back. And because you remember, flights were not happening, the airways were closed, and one of the great stories of American finance is that no one ever talked about money. No one ever talked about the strength of the U.S. dollar. No one talked about a run on dollars. Roger was running the whole monetary system in Chairman Greenspan's place on 9/11. So it was quite an accomplishment, and he's to be commended for that, for sure. So anyway, so Roger has recently retired. He was the CEO, I think, for what? How many years, Roger?
13.
And he's obviously a corporate leader. TIAA is the leading provider of retirement services and planning for nonprofit institutions, so including academic and research and medical and cultural institutions. There's about $1.3 trillion in assets under management now, and about, if I remember right, about 5 million individual customers and about 15,000 institutions. So we have a lot to talk about in terms of the economy, in terms of the marketplace, in terms of a balanced portfolio. But anyway, Roger will make some introductory comments, and then we'll get back together and do our fireside chat. So Roger.
Great, Richard, thank you so much for that introduction. And as I said to Richard earlier, he was one of the first people I met who knew things that didn't come out of books. He was an entrepreneur, and I was then and am now in deep awe and have a great deal of respect. So I'm going to try to share my screen here. Let's see if this works. I hope it does. So I'm hoping you're seeing a screen that says prospects for financial markets. I'm going to just go through a few slides here to try to answer some questions on where's the market, where's it likely to go, and what's driving it, and then we'll see. Then we'll go back to the Q&A. So if I can get it to move forward, I will, but it looks like I can't. So let me stop sharing the screen and just simply go to what I want to do, which is to talk about where markets are going here. And so one of the first questions that people often ask is, well, where are markets going? And let me go back. Here it is. The answer is we aren't really sure if we try to look at where they have been most recently. So what this slide shows is what we in economics call a scatter plot. So it shows last year's market and the year subsequent, the following year. And as you can see, there's really no relationship. So year over year, we really don't know where markets are likely to go. And that may give you a great deal of comfort or not very much comfort at all. But if we go to the next slide, you'll see actually there are some regularities in markets. And what this shows on the left is something called the cyclically adapted or cyclically adjusted price earnings ratio. So this was a concept created by a guy named Robert Shiller, professor at Yale, won the Nobel Prize for this concept plus a few others. And it basically says, what's the PE in the market adjusted for the cycle, where we are in the cycle? And what you see here, there are two different versions of this, but it basically shows that if the cyclically adjusted PE is relatively low, below 10 times, as in the far left on these bar charts, the next 10 years, you're likely to have above average return of around 16%. If you go
Roger, I'm sorry,
yes.
I'm sorry, I don't mean to interrupt, but we can't see the slides. And so I'm getting a few comments from folks that they can't see the slides and they would love to see them.
All right, well, let me see what's going on. I'm not sure what the problem is. Let me step back and go back to Zoom and go back to share slides. Chris, have you let go of it? Or I'm sorry, Claire, have you let go of the sharing so I can share my screen?
I believe that yes, you are a co-host, so you should be able to share your slides.
All right, well, I just hit share.
There we go.
Okay, we can definitely see them now.
Okay.
Hit
Okay.
slideshow in the orange bar. There you go.
All right, so now you're seeing it. Are you seeing the slides now?
Yes.
Yes,
Correct.
we are.
Great. Okay, good. So the technology did not overcome us. So anyway, to back where I was, so you see in both of these charts, the left and the right, a relationship between the cyclically adjusted or cyclically adapted PE ratio and the 10-year S&P. And what it basically shows is in any 1 year, if you're starting at a very low PE, the next 10 years, you're likely to get a higher PE or return, I'm sorry, on the S&P. So in the bar charts, if the cyclically adapted PE ratio is below 10, which is below the norm, for the next 10 years, you're likely to get a mid double digits return in the S&P. And if you look at the bar chart going down, if you've had in a particular year a very high cyclically adjusted PE ratio, for the next period of time, you're more likely than not to get a lower S&P. The chart on the right shows that in econometric terms, and you see this downward slope. You see a lot of darts and a downward sloping line. It basically says the same thing. So basically, what we are seeing is, ironically, or not ironically, interestingly, there actually is a way to think about the most likely outcome for the market next year and the next 10 years, and it's to look at where the cyclically adjusted PE is in any given year. If it's above average, you're likely to get a lower than average return in the S&P. If the cyclically adjusted PE, known as the CAPE, is below average or above average, you're likely to get a lower. And in fact, for several years, the cyclically adjusted PE has been above average. So I have been thinking, well, the next year or so, it's going to be below. And if you look at the right chart with that scatter plot and that line, that red dot was what I thought the market would do last year, which is I thought it would be about a 4% return. So what happened? All of you know that it wasn't a 4% return. It was a much higher return than that. So if you look at this chart in the far right, you'll see a big blue and light blue and dark blue chart. So last year, the S&P returned about 15%. I thought it was going to return about 4%. So why was that the case? Very simply, because we had fiscal stimulus where the US federal government not only matched, but increased or went above what otherwise people would have earned in terms of their personal incomes. And so this chart shows for 2020, starting in March and going through the rest of the year, in the dark blue, what people actually would have earned in wages and salaries, and in the light blue, the income support from the government. So what you see was that last year, one of the reasons that the market did far better than we thought was that the government was supporting incomes through fiscal policy well above what people would have earned otherwise. And so we had strong fiscal policy. So if we go to the next chart, what we also see is a second thing, or another thing, that drove strong markets last year, unexpectedly, so to speak. Because of the crisis, the Federal Reserve said that it was going to change its approach to monetary policy, and particularly to inflation targeting, and was going to be much looser than would have expected otherwise. And why is that the case? Well, the chart on the left shows that for many, many years, the Fed, Richard knows it well, I know it well, had said we want inflation around 2%. And unfortunately, inflation underperformed or undershot the target and was never close to 2%. And so what the Federal Reserve said was going to be very, very stimulative. And markets heard that. And if you look at the charts on the right, it shows that for many, many years, interest rates have been coming down. So two things supported the equity markets last year: income through federal government support, and the monetary policy, which was remarkably loose by historical standards. That led to something else, which is stocks and bonds had been, for a period of time, positively correlated. And that has created, a long tailwind, behind equity markets, which is to say interest rates have been declining, prices of fixed income securities have been increasing, they're inversely correlated, and equity markets have also been increasing. So we've had long periods of positive correlation, and that has also been driving the markets. Now, we should know that when those correlations change, markets tend to get volatile, which is to say, when interest rates start to rise, equity markets become much more volatile. So we have a number of factors that supported equity markets last year. If we think about what's likely to happen this year, we think the possibilities that equity markets will still increase, but maybe moderate a little bit. Now, why would that be the case? Well, if you look at this chart, what you're seeing is the S&P prices, which have been rising quite dramatically, 15% last year. If you look at earnings per share growth, it's been much more moderate. And so if this year corporate earnings really continue to do well, that light blue line trending up, that will support equity prices where they are today, but may not support increased equity prices. So one theory is that we'll find the equity prices continuing to be stable, maybe increase somewhat as the earnings per share growth catches up with equity prices. And I only emphasize that's one theory because we're seeing already equity prices are much stronger, and Richard and I can talk about why that is the case. So let me go to my last opening slide here, which is what's the outlook? And so my view is that there's some upside potential this year. What's happening? Well, first, the US economy is very well stimulated with the Biden administration already put in, as you know, several trillion or 1.2 trillion, and an expectation of even more coming up. So we have a very well stimulated US economy, likely to lead to global growth. We've been revising up, in fact, our global outlook, which should help cyclically positive stocks. On the other hand, that also is bringing a risk forward, which is the risk of inflation, which many have been talking about, and Richard can talk about that. We would say, however, not all financial assets will benefit equally from an economic boom. And I believe that there was going to be a rotation into economically sensitive assets because of the very strong rebound, suggesting or driven by strong balance sheets, economic growth, and a sharp bounce potentially in corporate profits. And Richard and I can talk about some things that might, create a risk there. So what are some of the best opportunities? Assuming that the vaccine continues to roll out and the economies around the world continue to heal, we see four particular areas that might be potentially good options in terms of where equity markets are likely to outperform and what otherwise could be a pretty strong market anyway. One is emerging market assets. Secondly, US small caps. Third, leveraged loans and other floating rate assets. And then most real assets, including potentially real estate. So this is a relatively positive story. As the first chart said, welcome to the upside scenario, but there are some risks that Richard and I can talk about. But I'd say overall, supported by fiscal policy and monetary policy, we're likely to see equity markets continue to do well this year. So let me now stop sharing my slides. And Richard, let me turn it over to you for the Q&A.
Wow, thank you, Roger.
Mm-hmm.
It's so interesting because I find that everybody I talk to is optimistic, which makes me scared.
Right.
Right. I mean, it's sort of this uniform idea today that coming out of COVID restrictions, there's going to be people spending money. The savings rate last year was 30% or higher, which was very unusual, as you know. You're talking about tremendous stimulus from the government to in people sending checks to people that are, for the most part, I think, going into savings banks. But I guess the question is this, at the same time, is this, is this irrational exuberance? A term that we learned from Chairman Greenspan, that here we have a stock market that it couldn't be, literally couldn't be higher, but at least at this point, it's at historic peaks. Is there more risk, on the investment side than there is on the chance of the stock market going the other way quickly? I mean, what could trigger the other scenario, I guess?
All right, so great question. It's obviously an important one. So is it a rational exuberance? I'd say it's not irrational in the following sense. The exuberance is driven by three things. A Federal Reserve that says we're going to keep interest rates low for a relatively period of time. An incoming administration that says we're going to churn out stimulus at trillions of dollars on top of trillions that's already there. And though it's very uneven, a rollout in vaccines that suggests a reopening in the US and over time Europe and emerging markets. So I wouldn't say it's irrational. Having said that, there are some risks, right? So this is dependent in some part, equity markets are dependent in some part on inflation being relatively contained, and there is some concern about inflation and maybe the Fed having to raise rates more quickly than we would like. There's some concern that maybe corporate earnings will be pressured a bit more than looks likely today. Your point is certainly well taken that a lot of stimulus, but is that actually going to go into spending or simply going to go into savings? Yeah. There's also some concern in that there some asset markets look, shall we say, fully priced, if not a little frothy. So some risks is clearly there that might say, oh, this happy days are here again, may not actually be true.
Yeah. One of the things that I'll share with everybody is that my portfolio of companies right now are all involved in infrastructure, which is probably, most people would say, is a pretty good place to be right now.
Right, absolutely.
So I'm kind of I'm in favor of whatever infrastructure the government wants to make. But what's interesting is what's going on in my company when I see across, and we do business across the whole country and it's in the road. We retexture roads. We take rubber off of runways at the airports. We redo concrete and running paths and lots of stuff. It's the costs of labor are going up dramatically. In fact, it's hard to find people that want to work. We're literally paying $75 an hour for truck drivers in certain places. And then I know the cost of building materials, the cost of lumber's gone up 250%. Basic commodity prices are just going through the roof. Why isn't there more concern from the Fed, particularly about inflation? It's almost as if no one wants to believe that we're going to reinflate.
I think there are two answers to the question. One is they've undershot inflation for such a long period of time. When I was at the Fed in the late 90s and mid up to 2006, we were marveling at how stable inflation was, how low it was. Frankly, had some anxiety that things would get even worse. So one of the reasons that I think the Fed is pretty, at this stage, calm about inflation is they've observed that inflation has undershot their expectations for a long time. The other is they have actually changed their mindset a bit and said, guess what? We like to see inflation running just a little bit above 2% for a medium term. And they've become much more, I think, frankly, relaxed, maybe even hopeful that we'll see a little bit of pickup in inflation. And the third is there's a really strong sense that the kind of inflation pressures you're talking about are due to temporary bottlenecks, and that folks will come back in, and those drivers that are getting whatever $75 an hour or less will start to command more moderate raises, so or wages. So there's also the third thing, which is they're expecting temporary bottlenecks leading to what they call transient inflation. and not a real buildup in systemic inflation. So we'll see if they prove to be true, because there are certainly some strong arguments on the other sides that maybe inflation really actually will be picking up and building up here.
Yeah, I mean, do you think there's, I mean, particularly given the kind of support coming in, trillions of dollars coming into the economy from fiscal policy, on top of what looks like a healthy economy and growth in basic industries. I mean, isn't there a real risk that the Fed then overreacts the other way? I mean, the message they're giving now is that until 2023, we're holding tight, we're going to keep rates low, and that's buoying this market dramatically. And it seems to be a real risk, therefore, of it having to go the other way.
I think there's a lot of uncertainty, to be very clear, right? Because they've now said, we're going to wait to see inflation running somewhat moderately above 2% for a period of time before we raise rates. That's a pretty big shift in monetary policy framework. It used to be anticipatory when we saw labor markets tightening and other indicia before inflation reared its ugly head. It was actually visible we were going to move a little bit because we knew that monetary policy worked with long and variable lags. That was the old story. The new story is we want inflation to run a little above our target for a little while, a period of time, and then we'll start raising rates. So whenever you move from one monetary policy regime to another, there's certainly a risk of a misstep. It's possible they miscalculate that inflation dynamics have changed dramatically because there's no more increase in globalization. We can only bring in the labor market or labor force from China and India once, and they're already, fully engaged in the global labor force, and there could be other frictions. So there's always a risk that they've got it wrong, and they will be a little late to the party, and inflation will run hotter than they like, and then we get an inflation scare, and they have to move quickly to catch up.
That's right. What do you think about you and I are both, approaching retirement age?
Speak for yourself, man. I'm going to be in the labor market for another 10 years, 15, 20.
By the way, I want everyone to know I gave Roger a bunch of crap for this black hair he's got.
What little I have left, it's still black. That's true.
But anyway, what is the average person thinking about retiring? I mean, there's a gap here in terms of income. The stock market has been great. The housing market has been great, so I can sell my house. I have some liquidity. I have some equity. The stock market's been treating me really well, and it seems like all that's changing this year. The housing roar of 12% inflation in housing, and at least that's what it was in Colorado. My kids made 77% on their investment in tech stocks last year. They were smarter than me. So, but what happens now if I'm retired? I'm trying to figure out my nest egg. Where do I put money today?
That's a great question, because everything looks fully valued. So I always have 2 or 3 answers to folks who are close to retirement. First, recognize your retirement may be a little longer than you think. And the people may not know, but when the retirement age was set at 65, the life expectancy was actually roughly, mid 60s as well. Mm-hmm. Now the life expectancy has, for a period of time, been moving up. It's slowed down a little bit, but folks in retirement could expect to live 10, 15, 20, maybe 30 years. So that tells you think about your investments slightly differently. Secondly, I would say everyone should think about some form of guaranteed income for life called an annuity. Now, you shouldn't annuitize everything, and retail annuities perhaps aren't exactly right for everybody. So, get some good advice on it. But my company is an annuity writer, so we certainly believe annuities may be an important part of a retirement income story. And those could be fixed or variable. The third thing I would say to recognize is that there's going to be some risk, and you have to figure out the risk tolerance that you have. So I'd always encourage folks who are getting close to retirement think about what your risk profile is. You know, the model portfolio might not be the right one for you. None of those things is, you know, a specific answer to any individual, but those are the frameworks that I would use, which is, all right, do I have a source of guaranteed income that I trust? You know, am I planning for a retirement that may be, you know, 10, 15, 20, 30 years in length? And have I really thought about my risk tolerance? Because some folks, you know, can't stand the ups and downs of the market, and others are pretty comfortable with that. So, you know, those are the frameworks that I would use to think about retirement income.
What kind of returns do you think are available in the annuity market?
It depends, frankly. Right now, for, you know, brand new, what's called immediate annuities, it's actually, you know, not that attractive because interest rates are relatively low. You know, for my own company, we have an annuity where if you've been saving with us for a long period of time, we give what's called the loyalty bonus. So we give back some capital in order to sweeten the return over this period of time. But, you know, this is certainly a time where you have to say, how much, if I want to annuitize, how much do I annuitize? The other thing to think about if you're an annuity purchaser is there fixed annuities and variable annuities. And a variable annuity allows you to get some of the equity upside as well. So, you know, talk to an advisor, think about it carefully, and most importantly, think about, you know, sort of a balanced, diversified portfolio.
Yeah, that makes sense. Why don't we talk about the dollar for a minute? So, I mean, if I look at what's happened to the price of gold, or look at the price of Bitcoin,
Right.
the value of the dollar has gone down anywhere between 70% and 1,000%, but they may not be the right measurements. How should we think about the dollar?
Well, you know, you're right. I'm not sure those are the right measurements, right? Because certainly Bitcoin is highly speculative and it moves up and down quite a bit literally from day to day. And over long periods of time, you know, gold, I think generally is not proven to be the inflation hit that people thought. You know, more broadly, actually, the dollar has been pretty stable. The Fed's been pretty good. We talked about inflation. So inflation is a way to think about how much value the dollar loses every year against a fixed basket of goods and services. And it's actually been pretty moderate. So inflation running, you know, 1.5% suggests that the dollar has been really, you know, quite stable. And I think that's, for most people, the better way to think about it. The challenge is, as you point out, there are different asset classes where that stability of the dollar maybe hasn't played out. So, you know, real estate in some cases, equities, you know, you point out, you know, speculative Bitcoin investments. But I would say overall, the dollar has actually been pretty stable against the baskets of goods and services that most people are buying or spending most of their money on. And that says the Federal Reserve has done a pretty good job.
Yeah, I agree. I would agree with you. Did you put some money into Bitcoin, just as a curiosity?
You know, I have not. I am actually going, once I leave my current job at the end of this month, I may well, you know, get a wallet just to understand what this is. But I don't see Bitcoin, frankly, Richard, as a investment. I think it's more of a speculation. And we'll watch and see. But no, I am not, you know, an aficionado of, quote, investing in Bitcoin, because I don't think that's really what it is right now.
You probably don't know this, but we had a session on Bitcoin and those currencies I think it was about a year ago or so. And my view was to stay away. So yeah. my crystal ball wasn't very good.
Well, I disagree with you. I think your crystal ball was good in terms of a long-term investment. For somebody who wants hot money and exciting speculation, that was it. But it's possible that, you know, 2 years from now, Bitcoin could be back down much below the current valuation. So I think I'm roughly with you for the investor. For the speculator, you know, small amount of money in Bitcoin could make you feel like you're a genius. But, you know, tomorrow you might not feel exactly the same way. Who knows?
It's certainly speculative. So let me ask you the question that we get at almost every one of our financial series presentations. How much debt can we take on? When does it break? I mean, what's the theory? What's the reality? I mean, how do we just passing this on to future generations? You know, what are we doing?
Right. So the answer to the question is for sure passing on to future generations, right? You know, because debt is always, you know, passed on to future generations. And by the way, I think the risk of more debt is far higher than the risk of less debt, in that we've got Social Security, Medicare, Medicaid, lots of things coming up from demographics that are going to suggest that the US government's going to have to spend much more and probably is likely to be in a position of having to borrow more money than is currently expected. That's point one. Point two is, you know, among economists, there's a real sense of, well, gee, interest rates are really low. And I've heard really smart, you know, savvy economists over the last few years recognize that with interest rates this low, maybe we should be a little less concerned about debt. I'm not sure I agree with that fully. And the final point that we observe is, interestingly enough, markets have been willing to absorb this huge increase in debt. And I think that's really a reflection of the fact that the US economy is still widely respected as the most stable, the one that's most likely to grow, frankly, the one that's coming out of the COVID pandemic a little ahead of Europe and others. So we're playing a little bit of a deeply uncertain game, building up deficit, more debt. We know that we're burdening the future generations, but right now interest rates are low and the market's not expecting or driving dramatic increases in bond prices. I emphasize dramatic because actually bond prices have been going up. So we shouldn't pretend that they haven't been.
I think rates have gone up in the first quarter. Almost
rates have absolutely gone up. Yeah.
Historic levels.
Yeah.
Does it give us an undue, unwanted political risk, a sovereign risk with the Chinese going to keep buying our debt?
That's an interesting question. So here's what one should understand is a large percentage of the Chinese reserves are in the US dollar and treasuries basically, and also corporates. And so if they decide to stop buying or they decide to use, you know, debt in a political way, guess what? They'll be harming themselves because the debt that they hold will go down in value. And so I think from a game theory standpoint, the Chinese are probably not likely to use their massive holdings of treasuries as a geopolitical tool to pressure the US, because they'll hurt themselves as much as they hurt the US. Now, you know, I could be wrong. You know, tomorrow's headline could prove me wrong. But on my view is I wouldn't look at the Chinese holding of US debt as a giant geopolitical challenge for us right now.
Yeah, and the Fed really doesn't have room to keep buying on their balance sheet, do they?
Well, you know, that's a good question to which I have to say I'm not sure. You know, the way you ask the question is a leading question. So when I was at the Fed on 9/11, we got to the largest ever balance sheet of the Fed. It was about $1 trillion. Well, you know, now the balance sheet is much bigger. So the Fed can actually continue to do this. I don't know if they want to do it. I don't think that's what they're signaling. But I wouldn't worry about the Fed's, you know, balance sheet as being the limiter. I think it's really much more the market and, you know, long-term planning for how much debt the US is going to have to issue going forward, and the need to try to get to some fiscal consolidation, as we call it, in order to make room for future borrowing.
All right, look, we've done well staying away from politics, but I have one more question. One more question before we ask Claire to jump back in with audience questions. What do you think the impact would be of a significant increase in cap gains taxes?
Well, you put the word significant in there, right? And so we know if it's significant, we know full well that it's going to make, you know, the holding of equities a bit more problematic. But I think the trade-off is going to have to be back to the point you made earlier, which is we also know at some point we're going to pay for all this debt and, you know, and reduce the deficits, and that does mean, like it or not, some increase in taxes somewhere. And, you know, cap gains might be one of them. Income tax, the marginal income tax for upper level earners might be another. Obviously, already a corporate tax increases on the table. And so I think all of us have to get used to the fact that we can't have it both ways. You can't both be anxious about the debt and the deficit and then say, well, but we don't want to see any increases in taxes. There will be, I think it's inevitable, there's some increases in taxes. And the issue is really, how does it get structured so that it has the right set of incentives around investments and savings, et cetera?
Yeah, well, things are going quite well, and there's so much optimism. It almost seems like a wrong answer to me anyway, that why do something to stop that?
No, I agree with you, but but your earlier question was, what about all the debt? And so the only way we're going to decrease the long-term debt burden is to decrease the deficits. And a way, not the only, but a way that I know is very much on the table is tax increases. And so the issue from my mind is, if it's inevitable, the challenge is then what's the effective tax rate, how is it structured, so as to avoid putting downward pressure on things like equity prices, and most importantly, I don't want taxes to discourage investments for the future.
Yeah, totally agree. Claire, do we have audience questions?
Yes, we have many audience questions. I'll start with Bill's. He points out that COVID is surging in Europe, and in many emerging areas, they've yet to really deploy the vaccine. How does this impact your outlook?
So I think that's a very, very important question. So my outlook was, driven around two things. China's already come out. They are an engine of growth. The United States looks like we're doing reasonably well and likely to be an engine of growth as well. But Bill is absolutely right. I worry a great deal about Europe moving somewhat slower, maybe very slowly. That's a problem, and absolutely true on emerging markets. So if I had to put a downside risk on what has been a general sort of upward trend and forecast, he's put his finger on it. Europe is disappointing in the rollout of the vaccine, and the emerging markets are clearly struggling. So I think he's right to raise the question.
Yeah, by the way, I would add Canada to that equation.
Yeah, Canada's had some trouble getting their vaccines.
And it's in almost total lockdown.
Yeah, Ontario, I think, again, is back in total lockdown, others as well. So it's really problematic. I mean, we're looking at the US where things look reasonably good, but around the world, much more challenging.
Yeah, I think that's right.
So our next question comes from Lauren, and he's asking, what are your views and analysis of the strengths and weaknesses in the next Biden administration proposal to invest in a broadly defined set of American infrastructure sectors, everything from elder care to apprenticeship programs?
So look, I think that's in general, I think what the president is proposing is probably called for. I think we have underinvested in education, apprenticeship. We know we have issues around elder care. Where the challenge is how much should we invest? And back to the point Rich and I were raising, how do we pay for it? And so I rather like the thought that it's time to think about doing more investment in some of these fundamental infrastructure issues and social issues. But we need to hear a bit more about exactly how that's going to be paid for. And to date, what the president has said is, well, corporate taxes need to go up. I think there's a compromise between the 28% that he's talking about and the 21% that we currently have. And I think he's focused on, increasing taxes on individuals above the middle class. And I think the challenge is, frankly, that might not be quite enough to pay for all of these investments and expenditures that he's talking about. So, like the concept, the issue is how much can we afford, and how do we pay for it in a way that doesn't sap, the investment and growth opportunities for the U.S. economy.
Yeah, I would agree. I think the broad definition of infrastructure is also interesting, and I think one of the things that may have been left out is the idea of cybersecurity. And I think I would add that to the broad list. But there's plenty of places to spend money and spend it wisely in broad infrastructure, from education to the whole internet to literally bridges and highways.
Yeah.
But how we pay for it, can be road tax, it can be gasoline tax, it can be more corporate tax, but that's the piece that no one wants to talk about. Someone has to pay for it.
I think Richard's right. And I'm glad he brought up the cybersecurity and roads and bridges and tunnels are all fine, but we also need the infrastructure for the 21st century, and that's the famous last mile and 5G and things of that sort. And Richard's right about, it has to be paid for.
So our next question involves supply chain. It comes from Nina. What are your thoughts about disruptions in the supply chain's potential implications on inflation and economic growth?
So I'll go first. I think the supply chain's implications on inflation is relatively short-term and transient. So once supply chains get rebuilt, I think the inflation from the transition starts to go away, and so that worries me not very much. I think her broader question, though, is an important one, which is so much of the low level of inflation we've had over the last 20 plus years has to do with an optimization of supply chain, moving production to lower cost, but still relatively high productivity areas. And I do worry that this notion of shortening supply chains may also mean that we aren't necessarily optimizing to the most efficient areas. And so you might get a one-time increase in the cost of business, so to speak. The offsetting factor to that is fewer geopolitical risks, more certainty. Let's think about the recent challenge in the Suez Canal. I'm not suggesting that's broadly generalizable, but it's sort of an example of the frailties to a global supply chain. So I understand we're going to be shortening supply chains. I understand why from a geopolitical standpoint, but recognize that may mean somewhat more inefficient supply chains, and that may mean cost levels that move up once to slightly higher levels.
Yeah, let me comment on that as well. I think there's one of the things that we always talked about at the Fed that most people perhaps didn't focus on was productivity in the economy. Mm-hmm. And we looked for constant productivity in terms of, how people worked, how the technology was impacting our economy, et cetera. And I think the recession we've just come through has some interesting side, notes to it. Was not a normal recession. The Fed actually talked about it as being an uneven recession. And it affected certain industries, obviously broadly in terms of leisure and the tourism industry, but also other industries got actually better. A lot of consolidation, a lot of marginal economies that are happening in distribution. The growth in this country and in the world out there is mostly distribution and warehousing and transportation, commercial transportation. And I think there's been a lot of productivity gains, and they'll be significant in actually, it's part of the supply chain, obviously, but it's a really an interesting view of how the economy is going to turn very nicely in the next year or two, is based on productivity gains in the distribution of goods. And there were a lot of lessons learned. I mean, if everyone remembers the Dell model, but Michael Dell made this model famous that he never touched anything that he made. It was all just in time. Someone else made the computer, someone else wrote the software, someone else had the chip, and it showed up at the customer's door without having any inventory at Dell. Well, when tariffs happened and markets changed, and the whole global economy became questionable, that model really was a deep learning curve for a lot of corporations. So I think we're come out of this uneven recession, I think, quite well in terms of lessons learned, the supply chain being really improved with consolidation. A lot of the weak players are gone. And I think we'll see real productivity gains in the next couple of years that really add to the enthusiasm for the economy. So it's kind of a net plus.
So our next question comes from Verna. It's a what if question. What about the impact of geopolitical shocks, such as China invading Taiwan or Russia invading Ukraine?
Right. So it's very interesting. If one thinks about the history of markets and geopolitical shocks, they tend to be relatively short-lived, frankly, which is not to say they aren't important. And it's not to say, China, invading or continuing to threaten Taiwan is unimportant, because I think it's quite important. But markets have a tendency to try to move back quickly to what they think of as markets think of as fundamentals. I've seen very few times when a geopolitical shock really impacts markets for long periods of time. There's a shock, it bounces back. So one shouldn't be complacent, and one shouldn't say, well, those things aren't important, but we should recognize they are very important in terms of global stability over long periods of time, but tend not to sort of sit on markets for very long either.
Yeah. One of the interesting things I found joining the Fed and having a whole bunch of PhD economists working for me was that it was the classic, on one hand this, on the other hand that. And when you try and pin an economist down and say, well, how about this or how about that, it was, well, we don't really take shocks into account, and because you really can't. And the hope obviously is they don't last long and you get past them. But there's lots of potential risks in the global economy, and particularly when the stock market is at a peak. I mean, if Iran sends a missile to Israel, I can tell you the stock market will go down.
No, look, I agree with what you completely on that. I mean, the market is certainly priced to perfection, and some shock would certainly lead to a correction. It could be, I don't know, numbered 5, 10, whatever percent, for sure, because one has to start to recalculate what's the world going to look like after this. So if you are a short-term investor, a shock is something to worry about. If you're in the markets for the next 10, 15 years, most shocks are just that, they're shock. But it doesn't mean that necessarily you want to rethink your entire portfolio strategy.
Well, it came up briefly, so I hope you don't mind circling back to it, and that's the topic of cryptocurrency. Mark asks, is it for real? Will it be around in the future? Should it be a part of an investment portfolio or a retirement portfolio?
So my answer is yes, it's for real. Yes, it'll be around in the future. No, I don't think it should be part of a retirement portfolio. And as I said, I think it's mainly a speculation. Now, I would also say there are two kinds of cryptocurrencies that we have to think about. There is something not very large yet called the stable coin. And those are cryptocurrencies backed by the dollar or a basket of currencies. Those might be investable assets. And then you get others that are not backed by anything, or basically backed by the ability of these high-tech miners to create more of them. And my observation is they've just been very, very volatile. So if you must have some, and there are some folks for whom this is a must have, I would say think about it as where you put your speculative money. You don't mind losing it, and you don't get overly excited if it goes up 30% in one day and goes down 20% the next. So, if you have a bucket of money that you want to say, this is pure speculation, and this is money I was thinking of going to Las Vegas with, and instead I'll do something else with it, that's the way I would think about cryptocurrency. So, it's not that you shouldn't ever own it, but just recognize what you're doing. And it depends a lot on your risk tolerance. If you're going to have sleepless nights when whatever it is goes down 10% or 20%, then don't do it. If you're prepared to do the roller coaster ride with a small amount of money that you recognize is for speculation, then maybe it's the right thing to do. Yeah,
I would agree. Doesn't seem like there's a lot of upside in investing in Bitcoin right now.
No, that right now it's had such a huge run. My favorite one of these is something called I think it's called a dog coin or something. It's Snoop Dogg put out a dog coin or whatever it's called a few years ago, purely as a joke, apparently. And it suddenly became an investable class. I was out with somebody a young man, and he said, you have the inside information. What's the latest tweet going to be that's going to drive up the dog coin? He was waiting for the coin to get to be 10. He had bought it at some number. And he said, as soon as it gets to be 10, I'm going to be a millionaire. And unfortunately for him, when I last talked to him, it was 8.5 and it never got to 10. So, I mean, it's just, be very, very careful of these things.
Yeah.
Our next question comes from Robert. Are the other major economies in the world following the U.S. monetary and fiscal policies?
Oh, wow. It's a very interesting question. It's a little uneven, frankly. So China has certainly been, stimulative. Europe is trying to be somewhat stimulative as well. So most of them are. I don't know where Canada is right now. And most of the emerging markets also are. So there's just a general sense that we want to refloat our economies as we turn the corner, and hopefully many of us get behind COVID. I think that's, as I quickly go around the world, most of them are pretty much following what we are. We are, I will say, in terms of fiscal, probably way out ahead of most others in terms of the amount of stimulus already in the economy, and it seems like more to come.
Last question comes from Lauren. He asks, does TIAA invest in Chinese companies? And what percentage of your assets are in overseas holdings generally, China in particular?
So we invest globally. Actually, we don't have very much in the way of Chinese companies, frankly, because of some concern about opacity and others. We had, but we divested from some Chinese oil companies many, many years ago. We do have actually investments on the ground in China. So we own 4 or 5 very upscale malls in China that are doing quite well, taking advantage of the trend towards the Chinese middle class and the desire to have, brand name, high-end luxury names. So that we do have. And we have, don't quote me exactly on it, but roughly 20% or so of our investments are global, but it depends on what class you're talking about. So we have agriculture, we have equity, most of our timber is in Canada and South America. And so we are certainly globally diversified, overcoming this trend, which is among retail investors, which is called sort of home bias. So I may have the numbers off slightly, but you should actually think of us as a global investor. And we do have some exposure to China for sure. Not primarily through equities, but through other investments on the ground there.
Well, we are just about out of time. As I said to you earlier, I would give you all the last word. I'm wondering if I can tweak that a little bit. You started off the program talking about irrational exuberance, and I'm wondering if you could characterize how you're feeling in particular about the economy over the course of the next year or so. And why don't we start with Richard, and we'll finish with Roger.
Okay. Well, thanks, Claire. So I did my own survey in anticipation of this session, and it was to my children. So my children are age 26 going on 27 to 48. And I asked each one of them, how are they feeling? How do their friends feel? And what do they think about the economy, about a $1.9 trillion bill, about all inflation, about all this things that are going on in our world? And 201, they said, we all feel confident. We're not worried about what's going on. Most of them aren't thinking about the things we're thinking about and talking about on this session. So I think there's a generation of particularly youth and the under 40 group that are very optimistic, which I think is quite positive. So if you'd asked me even a month or two ago how I felt about the economy this year and next year, I had some worries, frankly, because I really thought the stock market was being overvalued. I thought it was the cost of commodities and the cost of labor were going up too quickly, that the Fed really wasn't keeping an honest eye on inflation and fundamentals. So, but I think I'm actually quite optimistic, having done my own survey, that there's an optimism in the marketplace that's pretty strong.
So I have to agree with Richard. I've done a different kind of survey. So I'm in charge of the survey for something called the Business Council, which brings together roughly 170 global CEOs. So the last time we surveyed them, they were optimistic. So that it mirrors Richard's children's survey. We see a lot of stimulus. I would say though we should all be a little concerned because we're running a very interesting experiment of economy that's probably going to heal quite a bit, and then we're adding fiscal and monetary stimulus to it. So I think we're going to have 2021 good year, 2022 probably a good year. We have to watch though to see how things balance out around the longer term issues and intermediate term issues that we're talking about. That's not a forecast of doom. It's just simply to say, we are going to have to, over time, raise taxes, think about the deficit, a variety of things that may slow us down a little bit. And this pandemic, as one of the questions indicated, looks like it's receding in the rearview mirror here in the U.S., but not necessarily true in Europe and the emerging markets. And that could also be a little bit of an overhang. So I am, as I said earlier, optimistic, but in the short and intermediate term, with also a little bit of sense of some risks that are out there as well.
Yeah. Well, we certainly
Thank you both. Yeah. I'm sorry, Richard.
I'll say we certainly haven't answered the question about how much debt we can take on. We'll do that in the next session.
Yeah. Unfortunately, my experience with debt is, when you have too much because the market tells you, but until then you're not so sure. So we'll see.
Okay. Thank you so much, Roger.
Yep.
Thank you both. This has been an amazing conversation. Roger Ferguson, Richard Bard. Everyone at home watching, thank you for joining us this evening. We're taking a brief hiatus, but we will be back on May 19th with a discussion on the U.S. Constitution. Good night and thank you.